And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Monday. It's also the last couple of trading days of the month of September. Getting ready to wrap up this quarter. We've got quarter end rebalancing today and tomorrow. Then we also kick off October, which begins earnings season. So lots of stuff getting ready to go on. Interestingly enough, quarter four, the fourth quarter of the year, tends to be one of the strongest performance months or quarters of the entire year. About a 4% advance on average in October, November, December, and it's about twice as strong as the other quarters of the year. So again, we just had a fairly strong quarter in quarter three, which is typically a weaker quarter, on average about a 0.7% advance, but again, kind of defied the odds in the quarter three, but quarter four tends to be fairly strong. And a few reasons for that is because, first of all, you've got a lot of professional managers now, underweight equities at this point, and they've kind of been chasing performance a little bit so far, but primarily still remain underweight things like the Mag 7, the big cap tech stocks, those type of things. So they're going to have to get positioned for year end. And so as they try to play catch up in terms of the markets, try to catch up in performance, so to speak, to catch up with the returns for the markets of the year, again, they potentially suffer career risk. That typically puts a bid under stocks. Then also we'll have the return of buybacks starting in October. Towards the end of October, buybacks will come back. About 24% of all buybacks get done in the last quarter of the year. So there's another buying impetus, and particularly with buybacks going to exceed $1 trillion this year, that's a good chunk of buying that will happen in the fourth quarter. Then lastly, you've already got good, strong momentum in the markets already. That momentum's kind of hard to stop. You've got a lot of FOMO in the markets. Retail investors continue to just pile into stocks right now. So there's a lot of support for the markets into year end. So again, there's, when you take a look at the market dynamics, if you're kind of sitting there, oh, this market's already gone too far, it's going to have a correction. It's possible we'll have a correction. Absolutely not dismissing that at all. October is known for having some corrections, and anyway, 3 to 5% correction, completely normal. We've talked about that before. But the kind of the overall picture bodes well. Once we get through quarter end rebalancing today and tomorrow, then quarter four starts, and that tends to bode well into year end. So again, the point here is not to be overly bearish right now going into the markets, but just to be aware that there's some seasonal tendencies that tend to support markets. And then just from a technical perspective, the markets are in a good position. That brings us to what you need to know this morning before the bell. Take a look at the markets. Last week we had this big 3-day sell-off, right? It was disastrous. 3 days the market sold off in a row. Terrible. Came down, touched the 20-day moving average, which is that running momentum line right now, which we continue to have. And again, this market's just held that 20-day moving average now ever since the April lows. But again, came down, touched that on Friday, bounced off of it. On Thursday, bounced off of it on Friday this morning. Futures are pointing higher this morning. With stocks up about 30 points on the S&P 500. So again, just in a good position here. Worked off a little bit of that overbought condition. So again, kind of gives the markets a little bit of room here. But again, markets are fairly deviated. We're about 10% above the 200-day moving average. So again, a correction back 200-day would be about 10%. But that 10% deviation is starting to get a little bit extreme. Normally between 13 and 15% of a deviation is about where markets peak generally. So if we get a push to that level. In other words, if we kind of push higher in the markets here over the next quarter, get close to 7,000 by the year end, which is kind of where some Wall Street targets are right now, that'll get you to about that 13% push. Now, there's some things that happen in the fourth quarter you need to be aware of. First of all, you have mutual fund distributions that happen in the first 2 weeks of December. You typically get a little bit of a correction there. So again, just because the bullish trend is intact, you're in a seasonally strong period, there will be some bumps along the way. So again, just continue to manage risk in your portfolio. But overall, we're still in a good position here. The bullish trend is in a good condition. And again, if we kind of go back and just look at this market going back to October of 2022, we just remain in a very strong bullish trend right now. So even though there's been some bumps along the way, here's that 20% correction we had in April. Even though we've had some bumps and bruises along the way, the overall trend of the market remains firmly intact. So again, just from a investment perspective, there's no reason to be overly bearish here. But at the same time, you need to be managing risk. There are risk pockets in the markets, and just because the market goes higher doesn't necessarily mean your portfolio will perform the same way. So again, just kind of be cautious about where you're investing and the kind of risk you're taking, and manage that risk accordingly. But that's what you need to know before the bell this morning. We are going to come back and talk a little bit this morning about a couple things. One, we're talking about some economic indicators that are certainly flashing some warning signals for the economy. But then also talk a little bit about how RSI, the Relative Strength Index, I did a study last week talking about how the RSI can give us some clues as to when maybe the next larger correction is going to come. So we'll talk about that next on The Real Investment Show. Don't go away.
Catch the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, like I said, we'll get into a couple of things this morning. This past weekend, though, just real quick, was my daughter's 19th birthday. So she is just, getting older every day. She's my youngest, and so she's the youngest of the four. But we all went out to dinner on Saturday night, took her out for her birthday. Brent, you can share this picture. So we got all the kids together. Now, this is absent my son, who lives in the UK. He wasn't able to make it. So we took everybody out for a very nice dinner at Lamonte's Italian restaurant here in Houston. If you haven't been there, it's over by Highway 6 on Grisby Lane. Absolutely fantastic Italian food. But anyways, great time. Everybody all got together. And so you'll notice my wife's in the middle. She has hair. Well, yesterday, I'm going to switch pictures on you, Brent. So yesterday was head shaving day.
Oh.
And so she had her head shaved yesterday. She has her next chemo treatment on Friday. And so we are going to be going through that. But it was a very big day for her, because she has this normally she has always had this very long, long blonde hair, very
luxurious
full, very
hair.
Luxurious hair. Yes, absolutely. Anyway, go ahead, Brent. Anyway, so yesterday, it was funny because we got the clipper out and nobody wanted to be responsible for shaving her head.
The first run.
Exactly. So eventually our oldest daughter ponied up and said, okay, I'll do it. And so they did it. But anyway, so she's hanging in there. She's being a troop right now, but she's my hero. Anyway, so that was our weekend adventure. Whew. But it was good. It was good. It was all good. So talking a little bit about the kind of the economy and kind of what's going on with markets in general. The issue is going to be what we need to think about in terms of the economy and ultimately its impact on the markets and how this all translates together. Now, I've got two articles out now on the website. One on Friday talking about the economic slowdown, and then the one today, which is talking about RSI. Now, we're going to go through both of these because these two tie together. And just because you have an environment where there are economic slowdowns, it does not necessarily mean that the market's about to fall apart at the same time. So this is why it's important to not get too tied up in narratives. For instance, today's daily market commentary is bust this myth that foreigners aren't buying our bonds. which has been one of these narratives that run around like, oh, nobody wants to buy, the dollar's dying, nobody wants to buy bonds, and yet we have record high purchases of foreign ownership in U.S. Treasuries. So again, just there's all these myths and narratives that people throw around. But just because it's a narrative or just because it's somebody's opinion doesn't mean anything. And so we have to pay attention to the data, because the data is what is going to help guide us through and navigate us through this kind of water that we're in. I mean, think about it this way, you're piloting a big ship and you've got to dock this ship in a port, and you can't see the port, it's dark outside, and so you've got one guy just telling you, like, well, I think it's really rough out there, so you should probably do something, right? But then you've got all these gauges, right? You've got GPS, you've got navigation, you've got satellite, you've got all these instruments in front of you telling you, and an autopilot telling you exactly what you need to do. Now, which one are you going to pay attention to? You're going to pay attention to some guy, screaming, there's an iceberg ahead and you're about to hit it, or, you can pay attention to your navigation, right? Same thing in the markets, is kind of set all these narratives aside, because again, a lot of people have, certain motivations. They have certain things they're trying to promote, a book, whatever it is. And so they're spinning this narrative to get clicks or views or whatever it is, but it doesn't necessarily help you manage your money, which is the whole focus of what we need to focus on. And that's the whole point of doing the analysis and looking at the data. So one of the narratives that's going on by Wall Street right now is that we're going to have a reacceleration of economic activity next year. And this slowdown that we're having right now, this is the soft landing. This is the fabled soft landing in the economy. So we've seen weak employment data, we've seen weak consumption data, et cetera. But somehow that's going to turn the corner here, and that things are going to get better fairly quickly. And this chart is of earnings estimates. Actual earnings, and then forward-looking earnings growth. And what you'll notice here, so the blue bars are the Mag 7 and the green bars are the S&P 493. Now, what you'll notice is that over the last 2 years, there's been very little growth in the bottom 493 stocks. Most of the growth in earnings has come from the Mag 7. Now, what analysts think going into next year is that that's going to change. Now the earnings growth will all come from the 493, and earnings growth will slow for the Mag 7. I'm not saying that's right or wrong. I'm just saying that's what they're saying. My question is if it hasn't happened in the last 2 years where you had this massively strong economic growth because of stimulus payments, because of all this money from the Inflation Reduction Act, the CHIPS Act, all those type of things, what's going to be your driver next year? Because you don't have any of those supports. Where's this earnings growth going to come from? Because it has to come from economic activity. So you have to be betting on a fairly strong recovery in economic activity to support that. Now, I'm not saying it can't happen at all, but I'm just saying that's where it has to come from. It has to come from earnings activity, because that's what creates the revenue, particularly for the bottom 493 stocks. So let's take a look at a few economic indicators to see if we can kind of derive what might actually occur next year. You want me to go back? No, it went back. Oh, it went back on me. Gotcha. So this is the leading economic index. So this is the 6-month rate of change of the leading economic index. So the leading economic index has a long history of being a very strong economic cycle indicator, except this time. We've had a very negative leading economic index for a couple of years now, and no recession. So does that mean it's just inevitably wrong and flawed? No, because there are some things that were occurring because of the pandemic. Again, the stimulus payments, the CHIPS Act, the IRA Act, et cetera, that just shoved trillions of dollars of money into the economy, which kept the economy going, even though the other factors in the economy that impact the leading economic index suggested there was a recession, but we didn't have a recession, right? Because employment remained stable, et cetera. That 6-month rate of change has now turned lower. So over the last 6 months, the leading economic index has begun to weaken again, still in negative territory. Now, given its long track record of forecasting economic downturns, that recent downturn of the last 6 months certainly doesn't augur for a much stronger rebound in economic activity in the next 6 months. Now, again, I'm not saying it's been wrong for 2 years, 3 years now. So I'm not saying it's right now. I'm just saying it's something we have to consider, that maybe the expectations for economic resurgence of economic growth may be a bit ahead of themselves. The other is the inverted yield curve. The inverted yield curve has a very long track record of forecasting economic downturns. Now, importantly, it's not the inversion of the yield curve that is the recessionary indicator. So this is one of the traps that people kind of get into, is like, oh, the yield curve's inverted. That means we're about to have a recession. We've heard this before. And you can bring this chart up, Brent. So whenever you have this recession, everybody says, oh, the yield curve's inverted. We're about to have a recession, but that's not actually the case. It's when the yield curve un-inverts that your potential for a recession increases dramatically. And you'll notice that going back to 1977, that it's the un-inversion of the yield curve when it goes from red back to blue. That's when the recession actually kind of sets into place. And there's some reason for that, because again, the inversion of the yield curve is because the economy is slowing down, and when it uninverts, that's where the economy is resetting itself, and that's why yields are doing what they're doing on between the 10-year and the 2-year between the 10-year and the 2-year yield. So again, that yield curve has uninverted, but we don't have a recession yet. Does it mean we won't this time? Possibly. Again, nothing's infallible, but this has a pretty strong track record of forecasting at least economic weakness, if not a recession. But it hasn't happened yet, right? What it does suggest, though, is that this inversion of the yield curve does suggest that the economy is getting weaker, because what you'll notice is, if you take a look at this chart, when you have the big spike in the uninversion, that's when the economy is the weakest. When the yield curve begins to head back, very slow process, right? So the yield curve spikes, it peaks, it starts to turn back lower again. That's when the economy is back on track, gaining traction, right? So again, we've just begun the spike, or the uninversion, which suggests that at least for a period of time here, the economy is going to at least be weaker, not stronger. Again, I'm not making the case of a recession. What my thesis is that expectations for economic resurgence, which will support the earnings growth to support current valuations, might be at risk. That's the thing we want to pay attention to. So here's one last chart. I'm going to chart you to death this morning, by the way. We've got lots of charts, lots of pictures for you. The other is that the percentage of total employees working full-time. Now, this is how many people that are working have a full-time job. And I've overlaid that relative to GDP and recessions. Now, what you'll notice is that there's a decent correlation between the percentage of total employees working full-time and the economy. And the reason is that it takes a full-time job to pay bills and to have enough discretionary income to support some economic growth. That's declining and has been declining here for a while, along with the economy returning to normal. So you'll notice that, post the pandemic, we had this big surge in economic growth and a big surge in employment, and that's been waning off. So as the economy slows, I need less full-time employees. So I'm shifting more to part-time, temporary work, et cetera, but I'm reducing my full-time labor force, which has an impact on the demand within the overall economy. Again, not necessarily telling you that there's a recession on the horizon, but it certainly doesn't augur for a much stronger economic recovery. If we were about to have a much stronger economic environment, we should see full-time employment at least becoming more stable, not weakening. So, and this also kind of feeds into consumer sentiment. At the end of the day, consumers need to be confident that they're going to have a job. And if they're confident they're going to have a job and a paycheck, they'll be out willing to spend more. We've talked about before that Ben Bernanke back in 2010 was famous for saying, he's like, hey, the reason we do QE is to boost asset prices in order to stimulate consumer confidence, which boosts economic activity. And that was the whole purpose of QE, which was to lift asset prices to get people more confident in the wealth effect, and they would go out and spend money in the economy. So if this economy is on a surge or on the cusp of a surge in activity, we should see fairly strong current consumer confidence, but also expectations should be higher. Here's a chart of consumer confidence. Now, this is a composite of both the University of Michigan and the Conference Board measures of sentiment to give us a broader look. You'll notice that they're all declining. We're not really seeing a big surge in confidence. It wiggles, it bumps up and down along the way, but the trend is clearly towards weaker confidence. And typically when you have this trend towards weaker confidence, you are either in a slower growth economy or a recession. So, again, just some considerations here to think about, because the most important driver of everything at the end of the day is the consumer. So if your bet is that this market's just going to keep running, it's going to be fantastic, and it's okay that we're paying 24, 25 times forward earnings for our trailing earnings right now for valuations, 22 times forward earnings. If your thesis is that's okay, fully valued, it's great, we're good, nothing's going to stop this market, that's okay, right? There's a lot of momentum behind the markets, but the thesis is all banked upon this idea you're going to have stronger economic growth to support stronger earnings to justify those valuations. And so all of this comes back down to the consumer, because why? The consumer is where economic activity comes from. The consumer is ultimately the driving force of earnings, right? The consumer has to go out and buy stuff. If I'm Apple and I'm selling iPhones and nobody's buying my iPhones, I don't have any revenue, right? So it comes down to the consumer. This is a chart of personal consumption expenditures versus the annual rate of change in S&P 500 earnings. You will notice there's a decent correlation between these two charts. It's because consumption is where earnings come from. I can manipulate the bottom line through buybacks, accounting gimmicks, cookie jar reserves. I can do all that kind of stuff to manufacture earnings in the short term. But at the end of the day, I got to create revenue. So all this ultimately hinges and, forecasts for 7,000, 10,000 on the S&P, whatever, all hinges on this idea that the consumer is going to be the driving force within the economy, and they're going to go out and spend money, and they're going to create revenue for businesses, and these businesses are going to be a lot that will generate the earnings for these companies that we're all willing to pay excess valuations for. Now, look, there's a lot of themes and things going on in the markets right now. We've got the AI story, we've got this data center build out, and there's a lot of things that can certainly keep the markets elevated here for a while. But I think you have to pay attention to the underlying fundamentals of what's going on that drives economic activity. Now, I'm not forecasting a major downturn in the markets. I'm not forecasting a major recession. What I am saying is that expectations for this resurgence in economic activity I'm not saying it can't happen. But the data suggests right now that the trend of the data is weaker and doesn't support this idea that all of a sudden magically 493 stocks are going to start generating all this earnings growth when they haven't been able to do it in a very strong economic environment over the last 2 years. That's the risk. So that brings us to our second part of the conversation, which is, okay, we've got potential risk in the markets. We've got a very exuberant bullish market right now. Everybody's just killing it. Just throw money in the market, you make money. It's easy, right? This has been the easiest period to make money in the market since the late 90s. Back in the late 90s, I used to go in the morning, you just buy SDLI, JDS Uniphase, companies like that, and just market would open up, stocks would be up 30, 40 points, and you just sell stuff, go home for the day. Easy, right? Very similar to today. I haven't seen a period like that since then. And I'm not saying we're in the dot-com bubble, but it's that kind of same mentality. And we're seeing that kind of same mentality with retail investors. It's just simply, why not take the risk? Roll the dice. And as long as it's working, it's fantastic, right? But this is why we come back to just talking about markets and dynamics and things that truly affect markets over time. And we have a lot of very bullish sentiment in virtually all asset classes, whether it's gold or gold miners or stocks or Bitcoin. I mean, there's just everybody's very bullish. Whatever asset class people are tied to, they're very bullish about that particular stock or that particular asset classes because it's all working. Kathy Wood is having a boomer year, right? Now, the performance of her fund, ARK Investments, is terrible over the last 5 years. But she's having a boomer year this year, right? So everybody's happy. Doesn't matter what you've got money invested in, you're probably making money. But those are also periods where markets become the most at risk. But as we said before, momentum can carry markets for a whole lot longer than you think. And, we kind of talked about this last week, using the analogy of the train. And when you try to slam on the brakes of the engines of a train, all the other cars behind you are just shoving you down the track because of the momentum. That's the same way with the market. So despite economic weakness near term, despite a lot of other concerns, right, there's nothing really stopping this market from going higher at the moment because we're at all-time highs. So there's no resistance. This is always one of the things always makes me chuckle about analysts, which are goes like, oh, we just hit another all-time high today. Well, yeah, you just had an all-time high yesterday. So if you're up 1/100% today, yeah, you've got a new all-time high. But there's also no resistance that at that point, the market's not butting up against previous tops or anything else. So there's very little overhead pressure to keep asset prices from moving higher. And that's where we are in the markets right now. The easiest pathway for stocks is higher at this point. And right now, like I said, there's plenty of targets for the S&P by year end right now at 7,000. Really nothing stopping the markets from getting there at this moment. It doesn't mean they will, but there's really nothing stopping them from getting there because sentiment, momentum, buybacks, all these type of things are in place to continue to drive asset prices higher. So part of this is just having to ride the markets at a moment until you begin to see broader concerns. Which got me to thinking, and so I wrote this article that's out on the website today right now, so you can go read the whole article, but it got me to think, I was like, okay, well, there are certainly some indicators out there that have a good history of telling us when markets are going to correct and that things are really overbought, extended, et cetera. And can those be of use to try to time how long it might be from kind of where we are right now until the next kind of downturn? Now, let me just give you a couple of caveats about this. I don't want you to go read this article and go, oh, well, this is absolutely, this period of time, we're going to definitely have this downturn. That's not the purpose of this article. I was just doing some analysis going, okay, look, is when we get to a certain level of overbought conditions in the market, how long is it typically before you get a more significant correction? So I eliminated all the corrections that are 3%, 4%, 5%. I eliminated the wiggles. I was looking more for pretty significant downturns or downturns that were related to some event of some sort, like Brexit, whatever, to kind of start measuring the time frame from when relative strength on a weekly basis grows above 80 on the index, a very high level, and how long typically is it before the market actually responds to that. So again, one of the mistakes that investors make is they say, oh, the market's overbought. We hit RSI of 80 today, and I better get out of stocks. Well, that's not exactly how it works, because once you get to a relative strength index of 70 or 75 or 80, whatever, and it's rising, overbought markets can stay overbought for quite some time because of the momentum. Again, back to that train analogy, right? The engine's slamming on its brakes, but then all those cars behind it are just shoving it right down the track, and that's the way the market works. So when the market gets to a very elevated level, it doesn't mean a crash is absolutely imminent and you should get out of the markets, right? Here's a chart of this is just a sample chart of the S&P versus the relative strength index. So this is the weekly chart of the S&P 500, and the red area in the background is a weekly relative strength index. And you can see where you've had peaks in the markets of when you kind of get above that top line of 70 on the relative strength index. And then you can see that there are eventually corrections in the markets, but not right away. As always the case. And so I started looking back and I wanted to do a longer term history of this. It's just over the last couple of years. Again, just an example. But as a good example of this, we had an RSI peak of 80 in August of 2024, right? And you had a little bit of a downturn in the markets, and then the markets rallied again to all-time highs. But then you had this negative divergence in relative strength all the way through March of this year. And then, of course, that was when you had the 20% downturn. So again, there can be a very long lead time between the peaks of these indexes or these indicators and the downturn in the market. But in almost every case, whenever you've had a very excessive RSI, you eventually wound up in a market correction of some sort. And again, the thing for investors is that a 10%, and I mentioned earlier in the Before the Bell segment that we're about 10% above the 200-day moving average. Can you imagine a 10% downturn in the markets right now? What that would feel like? That 10% correction would only get you back to the 200-day moving average, but you would be like freaking out. Oh my God, we just lost 10%. I'm getting out of the markets. This market's crashing, right? It's just a 10% correction. It happens all the time. Can you imagine something larger? How you would feel? But let's talk a little bit about relative strength here. So the relative strength index is a function of a lot of things in particular. But it's just a measure of, it's a mathematical measure of the change in prices. And so if I've got a very rapid change in price, the relative strength of the market is going to increase, and the more rapid that price increase, the larger that relative strength reading is, which is why it kind of measures overbought and oversold. In other words, when you've got a very high level of relative strength, everybody's in the market buying, right? So you kind of, it's this idea that eventually everybody's going to buy has already bought, right? And then sellers have the ability at that point to come in and start dominating price action if they begin to sell in earnest. And that's what causes markets to decline. That's what causes the reversal relative strength index. So all it is a measure of buying and selling activity in the markets at the end of the day. Historically, though, again, big drawdowns are uncommon. Here's a chart of average returns. And people talk about, the market just returns an average of 10% a year. Average returns are not average at all. They're all over the board. But importantly, think about that we just had a 19% correction in April. that only happens, a 10 to 20% correction only happens 7% of the time in market history. It's actually a fairly rare event to have a 19% drawdown, which is also one of the reasons to say we just had a 19% correction, a fairly decently rare event, which likely means we're not going to have another rare event of a 20 or 30% correction anytime soon. You just had one. A 10% correction happens more often, it's about 13% of the time. 10% advances are about 14% of the time. 10 to 20% advances in the markets, 21% of the time. But look on the other end of that, right? A greater than 20% decline only happens 6% of the time historically. It's a very low risk event. But they happen. Greater than 20% returns in the markets happen about 38% of the time. So average returns aren't average at all. And this is why relative strength can help us try to identify these periods where the risk of a larger corrective action is higher than not. This also works in reverse. If you have a very, very oversold relative strength index, like below 30, you're going to start pushing the bell curve towards a higher rate of return as well. It works in both directions. We're just looking at corrective actions right now because of where we are. But this is the relative strength index. And there's a couple of things going on in this chart, but this is the relative strength index overlaid to the S&P 500. These red bars that are going up are whenever the relative strength index, now this goes back to 1970, but whenever the relative strength index is above 80, you get a red bar. And again, you'll notice that just because the red bars are there doesn't mean you necessarily have this massive sell-off event, right? You go back to 1995, you had a very overbought market multiple times. You know, you were constantly hitting 80, and then you had things like long-term capital management, you had the Asian contagion, then ultimately you had the dot-com crisis, right? But it took time for that market to actually realize that event because you had so much momentum in the late 90s. You hit 80, in 2007, and then, of course, you had the financial crisis in 2008. So this, again, this is weekly. This is the 14-week moving average for relative strength. Okay? So the point that I went from here was I said, okay, well, let's take these readings above 80. And again, I'm not worried about little wiggles, right? 3-5% corrections, those type of things. I stripped all those out. I said, let's just look at the more major downturns and determine when we might actually see a bigger correction in the markets. How long typically is it from the peak of this relative strength index until you get a downturn in the markets? And so I went back to 1973 and I started tracking these things and listed the events that went along with it. But on average, it turns out that the average decline following a peak of 80% on relative strength index, about a 27% decline. Now, again, that's skewed by the fact that you've got some very large readings. For instance, 2000 was a 48% decline. 2007 was a 56% decline. 45% decline in 1973. That was 1973-74 bear market. So those kind of skew the data again because I just showed you that chart is that a greater than 20% correction only happens 6% of the time, right? So, you take the average decline of 27%. It's skewed by these kind of larger outliers like 2020 as an example. But on the right-hand side, I listed the number of weeks, the lead time between the peak in RSI and when the correction occurred. And again, when you get into a very strong momentum market, those lead times can be a lot longer, but the average lead time is about 37 weeks. So it's about 3/4 of a year from the time that you get it. So in other words, if we have an RSI peak of 80 on a weekly basis, you can start kind of counting from there, in theory, 37 weeks out and say, okay, when we get into later 2026, that's where my risk of a bigger valuation-driven correction potentially arises. But again, it can be a lot longer. It can be 43 weeks, 41 weeks. I mean, the dot-com crash took 92 weeks, right? So it can take time to get there. But the time is the most important thing. And this is the whole point of the discussion this morning with you, is don't take narratives and go, oh, that means the markets are going to crash tomorrow. This is why we go back to the economic data. This is why we go back to the fundamental data. This is why we go back to the technical data, because the technical data, the data, regardless of what it is, can give us a better indication of what to expect from markets. And right now, we've got a lot of momentum in the markets. You've got a lot of positive sentiment. You've got a lot of drivers for the overall market that can certainly keep pushing this market higher in the near term. But there are certainly things to come out. Here we come again. Another government shutdown right on the cusp, right? So again, what's that going to mean? Government shutdown is going to cause the markets to crash. That'll be the headlines, right? Oh my gosh, if we don't fund the government, we're going to default on our treasuries. We have the same conversation every year. Every year it doesn't happen. Every year we fund the government. We use continuing resolution. We never default on our debt. We haven't defaulted on our debt since the last 40 years of having debt ceiling increases. We have these shutdowns all the time. It's political theater. That's all it is. It's like, oh my gosh, we've got to lay off 900,000 non-essential workers. If you're non-essential, why are you working? Why are we paying you? We could save a lot of money. Trim our budget. But these are the things, right? So there's going to certainly be things that come up that are scary, these big scary headlines. They say, oh, the markets are about to crash. Maybe, certainly could cause a downturn. Again, a 3, 5, 7% correction in this market right now, a 10% correction in this market right now, back to the 200-day moving average would be completely healthy and normal. It would feel terrible because you haven't had that. We've had a very long stretch in the markets of days where we've had basically declines of less than 1% are rare. Right? Greater than 1% is rare, right? Advances, it's been a very low volatility market. We're up half a basis point today, half a basis point tomorrow, down 30 basis points. Very low volatility. So all of a sudden, if you got a 3, 5, 7, 10% correction, it's going to feel like a crash. It's like, oh my gosh, the AI trade is over. It's all done now. No, it's just a correction. But this is how we have to navigate portfolios, though. We have to manage that risk and understand that emotionally a 3 to 5% correction, completely normal, would certainly feel a lot worse than it actually is. Because we're just not used to seeing prices go down. April correction? What April correction? I don't remember that. Yeah, you remember that 19% correction in April, how you felt? Nah, I was fine. Didn't bother me at all. BS. That'll happen again. We have to navigate that. But again, there's nothing at this moment that suggests that the markets are about to just completely fall apart. There's nothing, all these narratives that are out there are simply just justification for why somebody's favorite asset class is going up. At the end of the day, it's just buyers and sellers driving the markets. Right now, you've got buyers and you don't have any sellers. And that's what's causing prices to go up every single day. Nobody's willing to sell here because they don't want to miss out. At some point, somewhere, someday, there's going to be somebody that goes, I'm out. Somebody important. And then that will cause a chain effect in the markets. And somebody else will go, oh, I'm out too. Oh, if he's out, I'm out. And if they're out, I'm out. And it starts rippling through the markets. And that's how you get a more substantial correction. But that takes time to get there. And we're not there yet. So anyway, both these articles are on the website. They both work together to understand that, hey, there are some risk. Economics and fundamentals are at risk right now, but momentum is driving the ship. And we just need to be aware of that data so that we can better mitigate the risk in our personal portfolios that we're taking. So again, those articles are on the website. Newsletter is out also this weekend, talking a little bit about overbought conditions. That's on the website. Be sure and like and subscribe to the channel today. I'd certainly appreciate it. And it certainly helps us a lot. We're also streaming on Facebook, LinkedIn, and X, and YouTube. So all of your favorite platforms. You're now finding us live there to help you manage your money better. Have a great day. We'll see you back here tomorrow with John Penn for Two Dads on Money. Have a great day.